Hey guys, hope you and the families are doing well. I'm going to teach you my trigger bar setup in this video, which I think is a setup that every trader should know about. Now to do that, I'm going to utilize both the daily chart and also the 1 hour chart, so we can go into some multiple time frame analysis and I can teach you some important concepts. We're going to be going through my trading app, which I took a position on the 25th of June, and at the time of filming this video, I still have a long position in the stock. Now this video, it's not going to be fluffy. It's going to be very detailed, very specific for what is it that I'm looking for, how do I actually identify the trade, how do I control the risk. Then we're going to go into some advanced topics on the risk mitigation side of things. So I'm going to teach you about free rolling, getting the position to break even. We can then talk a little bit about the optimizing profit. So you may recall from last week, I taught you about a pullback buy to the 50-day moving average, that shakeout demand tail in Kinross Gold. So this is the trigger bar setup, which is another entry method technique that I utilize. Before we get into the video, I'll let you know that MarketSurge are today's video sponsor. They are my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, then you will find a link in the comment section and the description below. Alright guys, here we go. Let's get into the video. So you may be looking at your screen right now and be going, there's way too much information coming at me right now. You've got this blue line, this red line, Jack. You've got the purple line, this green line. What on earth is free roll level 1? Why is that $1.97? And what does this mean 1 times risk? What's free roll level 2? Why is that $3.94 2 times risk? What's this SDT thing that you keep pointing at? What's this 50-day SMAG? What is all that about? Why are you pointing here with pink arrows and the volume's going down? What's this black line? Why you got a blue arrow there? Like, what's all this information? All this information is very, very important information. So hopefully by the end of the video, you will understand everything that you are currently seeing. So that'll be good. In about 10-15 minutes, however long this video goes for, hopefully you'll understand everything, all this labeling, what does it actually mean? So the way we're going to do this video is we're going to go through a logical flow. So when I'm thinking about trades, when I'm analyzing trades, I'm thinking first and foremost identification. Okay, there's 4 components of a trade: identification, controlling risk, risk mitigation, and then optimizing profits. We will put a heavy emphasis on the first 3 of those. We can talk a little bit about optimizing profits maybe at the end of the video, but what I do want to do in the identification part as well is take this video a step further. So you see over here we've got another chart. That's going to be the 1 hour chart. So after we've spoken about this on the daily chart, I'm then going to bring across the 1 hour chart, because the 1 hour chart can give you a really good intraday sense of what is going on. A couple of nuances there as well, some shakeout demand tails marking the lows. Maybe that's constructive, maybe that's not constructive. So let's get into it, right? So let's begin here. Really strong stock. I think in the introduction I would have shown you the MarketSurge data for app. Really good earnings estimates, yada yada yada. Relatively new IPO, strong stock for me, TML type stock. Okay, so you get this gap down reverse bar off the 50-day SMA. The stock then rallies, good earnings reaction, bit of a doji, but the market's been a little bit choppy, hasn't it? But you get the good volume coming through, gap up, tries to push, pulls back down. Okay, it's then kind of chopping around here, and then it pulls down to the 50. So the 50-day simple period moving average, which is the purple line on your charts, that is an area. Okay, it's a region where I'm looking for the footprints of large operators. And you might be like, what are you on about footprints? Like, what are you talking about footprints? By the end of the video, you may start to see the footprints. You may start to see the chart how I see the chart, or you may not. That's absolutely fine by me. But what I'm doing is there's certain moving averages as reference points that I'm looking for the bigger boys and girls to step up and support the stock. So when I'm thinking about large operators stepping up and supporting the stock, what am I looking for? I'm looking for visual evidence in terms of the candlesticks and the volume, and then how I link that back to signs of demand, absorption of supply, accumulation by large operators. So if you understand candlesticks, and I cover them in the blueprint video on the channel, then you may recognize these shakeout demand tails, which are hammers, doji dragonflies, Takuri line type candlesticks. You start to get this here. So what are these shakeout demand tails? Well, what does that mean? Like, again, it's about linking concepts of what do you visually see. So what we're trying to do is we're trying to take the visual and we're trying to turn it into mental representations. So when you see this, you start to associate and you go, that happening there, and it's the context. That happening there could mean this is happening. It could mean that's happening. Okay, is there potentially a trade identifying there? This is when you start to build your process. So what I'm looking at here, I'm looking, wow, there is a very big shakeout demand tail on the 11th of June on very high volume. Now, it's not just, there's a big shakeout demand tail around the 50-day. What we've also got to think about is the context of that bar, and we want to understand the footprints of large operators. Imagine that you are a trader, okay? If you're watching this video, you're probably a trader and you probably have a pretty good understanding of trading if you're already kind of like 10 minutes, 5 minutes into this video, or however far we are, right? But if you're thinking about this here, okay? Let me just do this and let's just change the color, right? If you look at this shakeout demand tail, okay, and I'm just going to do the kind of shakeout part in red. Okay, you see the shakeout demand tail. So this is the tail, okay, shakeout demand tail, because it indicates there's demand then coming through. You're a trader, right? Let's say that you're trying to get positioned. Let's even color code this, right? I told you this video is going to be thorough, guys, okay? It's not just going to be a video where you think you can watch a 5-minute YouTube video and off you go. It doesn't work like that, okay? It just doesn't work like that. So imagine that you're a trader and you're trying to buy this and get positioned within this proverbial blue zone. So maybe you're like, well, it's like just shaking out underneath the 21-day EMA. I'm going to take an entry there. Maybe you bought it off the 21-day there. You see these shakeout demands, so maybe you're kind of buying it in here. It kind of tightens here. Maybe you buy it in here or something like that. If you were trading with a relatively tight stop loss, okay, I'm going to guess your stop is somewhere in the blue zone. And even to like the lower of the blue zone, you're at like 9%. That's a wide stop loss if you're swing trading off the daily chart. So I would hazard a guess, right? I would hazard a guess that this bar here, if you're a trader and you were trying to get positioned in here, even if you were long the stock before here, I'm going to hazard a guess that shakeout demand tail just knocked you out of your position. Either it triggered your stop loss, or intraday, when this thing was looking terrible, slicing through the 50 and it's 4 or 5 down days in a row, and it's down here on the lows, you're like, this is horrendous. I'm out. So either it shook you out or it scared you out. Now you're starting to see the footprints. This is where we start to get into the concept of the footprints, the large operators shaking out weak hands, the games that they play. So is it reasonable to expect high volume on that bar there? Yes, and it's actually good to see. You may be like, well, there's a really large red volume bar and isn't that really bad? No, it's the context. Think about all the stop losses, all of the weak hands selling there, whether they're getting shaken out, whether they're getting scared out in that red zone. That is where the volume's coming from. However, remember, someone is absorbing the supply. Who is doing it? Well, I don't know. This is where we get into the large operator concept. What are they doing? Following their footprints. Then the next day, what do you get? Another shakeout demand tail that's an inside bar. And just before I forget as well, we're actually going to look at this a little bit later on the 1 hour chart. Okay, and it's going to be a big shakeout demand tail on the 1 hour chart when we look at it a little bit later, marking the low on the highest volume bar of the session, which gives me even more kind of weight of evidence that that is large operators up to their usual games. And then what do you get? Inside bar, there's a shakeout demand tail. And look how the volume's stepping down. What's that telling you about supply? It's lessening. Then there's a reversal, very V-shaped in nature, pulls back down, and then you get another shakeout demand tail followed by this inside bar. So a trigger bar, for me, is often a low volume, tight inside candlestick sitting around one or more key moving averages. It doesn't have to be an inside bar, but this is where you get the tight inside bar. Okay, this is the Minivini point. It's the Toby Crabell point. Okay, what you tend to see the market do is from periods of contraction, so contraction in volatility comes expansion. So this is the contraction in volatility. This is the expansion. But where does it happen? Well, it pulls down. You get this big flush, this big shakeout as we've been talking here. Then it runs up, very V-shaped in nature. Maybe you get a couple breakout traders taking it here. Then it looks horrendous on this day. Look at this. Well, it looks horrendous. But what happens on the next bar? Ah, you got it. It's another shakeout demand tail. And look at the volume. It's below this black line, which is the 30-bar average. What does that tell you about supply, about selling? There's not much. Structurally, what's happening? High, low. High lows, bullish or bearish? They're bullish. And then what happens? Then you get this low volume inside bar the next day. There's also got a little shakeout demand tail sitting right around the 50-day moving average in the context of a nice high low in a leading stock when you've just had this big shakeout. So I'm not chasing the V here. I'm going to wait for the high low. Wait for another shakeout, wait for the trigger bar. That's the entry through that. Stop underneath the low. Note the relative strength as well, which I forgot to mention earlier. So what I'm going to do now, that's the daily chart, a little bit higher, a little bit higher. Okay. What we're going to do is we're going to go take a look at this bar. I'm just going to circle it, and then I think it will show up when we pull this across. Okay. So let me just go and grab this. Okay, here we go. So what we're going to do, hopefully I'm still up here somewhere in the video. Let's pull it across a little bit more. So we're going to look at this over here in a minute, but take a look at this. Let's just clean this up a little bit for you. There you go. So this big red candlestick over here, okay, this big shakeout demand tail, huge volume coming through. What bar do you know marks the low? Look at this. See this here? Shakeout demand tail. So the volume is increasing. Okay, see how the volume increases? And the largest volume bar of this big red session over here is what? What is it? You got it. It's a shakeout demand tail. Look at this shakeout demand tail here. shakeout to Martel, marking the low, and then look at the strength of the reversal right afterwards. And remember where this is happening, context on the daily chart that we're then linking into concepts on the 1 hour chart. So you get a shakeout to Martel marking the low on the highest volume of the session thus far, followed by a really strong reversal on good volume. Now is that starting to look like the footprints? Starting to look like the footprints to me. Then if I just zoom over here, okay, so then what we're doing, okay, we're now going to look at the last two sessions. So tell you what, let me see if I can, on this one here, let me see if I can do this, something like this, pull this across like this. So now what we're doing, okay, is we're looking at this shakeout to Martel on the 21st of June and then the trigger bar on the 24th of June. There's a couple of things to note here, okay? So then when we're taking a look at the 1 hour chart, okay, remember I said it can give a little bit of insight what is going on during the session, a couple of nuances as well. So the first 1 hour candlestick, when the large operators are going to be most active, what do you notice? That's a shakeout to Martel. Shakeout to Martels, given the right context for me, are signs of accumulation and absorption of supply. Remember, we're linking what we see on the 1 hour chart to the higher time frame on the daily chart, and then it just kind of ebbs and flows a little bit. But then what do you notice? There's another shakeout to Martel. Look how that volume's drying up below the 30-bar average on the 1 hour chart, and then you get a nice rally into the close. Okay, interesting. And then what happens? We actually get this gap down, but note that it's a shakeout to Martel, shakeout to Martel, shakeout to Martel, inside bar as well. So you have nearly back to back to back to nearly back to back to back inside bars, and look how the volume's drying up. And then what do you get? A little rally into the close. That's trigger bar behavior. Low volume, really constructive price action. Okay, tightness and price from periods of contraction come expansion. A little nuance as well. So we're looking for the trigger bar on the daily chart around key moving averages. Could be the 10-day, the 21-day, the 50-day, clustering those potentially. But then when we take a look at the 1 hour chart, what I like to see is you'll see you've got this black, this blue, and this purple line. Now that is the 10 EMA, the 21 EMA, and the 50 SMA for the 1 hour chart. Note the close convergence of them. See that? Look how tight they are. So not only a contraction in price volatility, but a contraction in moving average volatility as well. So I'm then targeting it through the high hit. And then this is what the best stocks do. They'll just fly out of the gate and then I free roll into that. So let's now start talking about the free rolling side of things. So let's pull this across like this, okay? So now we'll talk about the risk as well. So you identify this trigger bar, right? So for me, what I'm then doing is going, okay, I want to target it through the high, stop, ascent underneath the low. So that's going to be, you see this 1.97. That is going to be $1.97, which equates to 2.51% risk. Now that assumes perfect execution. More likely than not, you're going to get some slippage, okay, trading through these areas. So assuming perfect execution, which again is rare, I get slippage on my entries as you probably do as well. But if we just go with the perfect execution, because it helps illustrate the points in a YouTube video like this, okay? So what I'm doing is targeting it through the high. So that's going to be a 78.34. This is where the labelings are going to start making sense. What I'm going to do is place my initial stop loss. The initial stop loss ascent below the low of the bar. Why? Well, because if I'm wrong, like if price goes below the low of the bar, I'm wrong. Like I'm wrong. My whole hypothesis, my whole reason for buying this is I think this is an area on the chart in which I think there could be a quick price advance to the upside. So that basically, if this happens and the opposite happens and it just starts taking out that, I'm wrong. And guess what? I'm going to be wrong. You're going to have losing trades. What do you want your losing trades to look like? For me, when I have losing trades, one, I want them to be small in relative proportion to where I'm targeting and achieving my average gain. And two, I want the losses to happen really, really quickly. So I'm not tying up capital. I just reset, recalibrate, go again for the next session. I don't want to sit there for days, for weeks, for months with a losing position going, oh, come back. I'm not interested. Want to stop me out? Stop me out the day I enter. Absolutely fine by me. I'll reset, go again for the next session. Absolutely fine. But I'm placing my initial stop loss here because that is doing two things. Number one, it's an obvious point in which I'm wrong on the chart. If I'm wrong, I just want to get out for reasons I've just mentioned. Also, it helps me control the risk. So as we were just talking with the identification, now we go into the controlling risk. So we're thinking about controlling risk. Remember, there's four main components to a trade: identify, control, mitigate, and optimize. Whether you're an intraday scalper, a day trader, swing trader, position trader, there's those four elements in every single trade. That's how I see it. So 78.34, that's where I'm targeting it through. Initial stop loss hit, 76.37. So that equals a $1.97 risk per share, which equates to 2.51% risk, okay? So that is then my out point. Now, if you look at that, 2.51% relative to this number up here. Now, this is the 20-day ADR percentage. Okay, what does ADR percentage mean? It means the average daily range percentage of the stock excluding gaps. So from low to high, the average daily range percentage. How much does this stock move around in the last 20 days? Now, why is that important? Because it gives us a feeling for how quick, or a visual guide for how quick or not this stock is. Now, if you keep in your heads, the average of the triple Qs and the S&P 500 is around 1%. Okay, you took an average of those. It ebbs and flows. Sometimes it's a bit more, sometimes it's a bit less. But if you keep in your head, the major indexes on average is around 1%. As I said, sometimes a little bit more, sometimes a little bit less. But if I start saying it's 1.13, you're not going to remember it. 1%. 1% for the major indexes. So this stock here is many multiples quicker than the major indexes. So it cuts both ways, both to the upside, but also to the downside as well. But what we're trying to do, and what I'm trying to do, is enter in which the point where I think there could be a very quick price advance and this stock could start trending to the upside. So it's reasonable to expect if the triple Qs, for instance, goes up 10%, this stock, given the ADR percentage is many multiples of the triple Qs, could go up many multiples of the triple Qs advance. So if you are trading stocks that have ADRs around the major index percentage, so 1.25%, it's very hard to outperform the major indexes because you're just trading stocks that are as quick as the major indexes. So this is where I think you've got to be looking at the quicker stocks in the market. If the triple Qs goes up 10%, I ideally want to be in the type of stocks that could go up 20%, 30%, 40%, 50%, 60% and greater. Many multiples of it. Okay, but this is an important concept. Thinking about the ADR percentage in terms of the quickness of the stock, but also thinking about the initial risk, which is 2.51% relative to the 20-day ADR percentage. Now, if you want to see the 20-day ADR percentage that I use, here are the indicators. Okay, this one here, ADR percentage by Armour Schluckler. That is the one that I use there. I'll take you through the fib retracement tool, how I set that up in a couple of minutes time as well. So with trigger bars, which are oftentimes these tight low volume inside bars around one or more key moving averages. Again though, I reiterate, it doesn't have to be an inside bar, but I like inside bars. Okay, oftentimes the better trigger bars, the initial stop loss percentage relative to the 20-day ADR percentage will be somewhere between half and 2/3. Half and 2/3. Okay, so here round about half. Okay, half would have been 5.02%, so it's pretty darn close. Okay, so I like that. It's a good risk metric. That also then helps me with the risk mitigation side of things. So let's go into the risk mitigation side of things. So what I do is I use the fib retracement tool. Okay, so this one here, fib retracement tool, and you can get it from this bar over here like this. If you put a little star on it, it'll then set up here in terms of your favorites bar. So what I'm going to do, this finger, I'm going to hold control. I'm going to snap to the high of the bar. I'm going to left click and I'm going to move my pointer down, pointer, cursor, mouse, what do we call it nowadays? So, and then going to left click on the bottom like this. So I've now snapped it to the high, snapped it to the low. But what I want to do is just bring the bottom down 1 cent like this. Okay, that then sets that up there. Now here is then what I do. Go into the style. Okay, 0 is going to be my stop loss level. 1 is going to be my entry level. 2 is going to be 1 times where the stop loss is. 3 is going to be 2 times where the stop loss is. So let's start talking about that. And I'm going to show you risk mitigation, and then I'm going to show you active risk mitigation. Are you ready to go down the Alice in Wonderland rabbit hole? I hope you are. So I'm targeting it here. Okay, so we're going to assume perfect execution. I buy it here at 78.34. As I said, in actuality, had some slippage as you would expect. Okay. So I'm buying it here in this hypothetical example that we're doing on YouTube. So my entry is going to be at 78.34. My initial stop loss is here, 76.37. That means I have $1.97 risk per share, which equates to 2.51%, but we're just going to keep it in the dollar figures here, okay? So $1.97 risk. So initial stop loss at 76.37 equals $1.97 risk per share. Okay, interesting. Now you'll see where we've got free roll target level, or free roll level 1. Usually I call it target, right? But it's up here at 80.31. Why is it at 80.31? Well, if you do 80.31 minus $1.97, you get 78.34. Okay, so imagine in a hypothetical example, if you bought 1,000 shares of this thing, okay, if you sold 500 shares, which is half of the position, at $80.31, you've just sold them at $1.97 gain per share. But you still have 500 shares with $1.97 risk associated with them. So you break even. Get it? This is the active risk mitigation side of things. So you'll break even. Now, can you get gap downs? Yes. Can you get slippage? Yes, when you're then getting stopped out. But then the idea is, well, if you can free roll it there, if it then comes back down to this level and you get stopped out here, around about here, you get some slippage, of course you can, right? We all get that, okay? But for this hypothetical example, if you were to sell half of your position here at 80.31 and then the other half gets stopped out here at 76.37, guess what? You break even. So this is called risk mitigation. So identify, control, mitigate. Like mitigate, mitigate, mitigate. I think it's so important. Like risk mitigation is ridiculously important, certainly if you're trading in a choppy market. So you can pause the video, you can go and look at the maths for yourself. Okay, work it out. If you bought 100 shares of this, 1,000 shares of this, 10,000 shares of this, however many shares you want to buy, okay, go and do the math. Take a look at the math for yourself. Okay, if you would sell half your position at 80.31, see what your profit is, and then obviously you got your remaining half, see what happens if you get stopped out at 76.37. You'll break even. You get it? Now what we could do as well is we could think about free roll level 2, which is 2 times our initial stop loss. So in this instance here, 82.28, okay, is $3 if you were to buy your position here. So your entry is here at 78.34. If you were to sell 1/3 of your position, 1/3 of your position. So if you bought 999 shares, if you were to sell 333 shares at $82.28, that would be $3.94 gain per share. But wait, you still have 666 shares with $1.97 risk associated with them. So if you were to then get stopped out, so imagine that you've just sold it here. Okay, if you were to then get stopped out down here, so you sold 333 of your 999 shares right here. Okay, if you then get stopped out on 666 shares down here at 76.37, you would be break even. Would you like me to bring up a calculator? And I will show you. Ready? Watch this, okay? So let's say your share size, 999 shares, and that's nice and easy, okay? So 333. So what you're going to do is this level up here, two times where your stop loss is. We'll get into active risk mitigation in a minute. So this here, 333 times by $3.94, like this. Ready? $3.94 means you've just locked in a profit of $1,312.02. Okay? Now watch this. So remember 1,300, okay? But you've still got, 666 shares. Okay, you've still got 2/3 of your position left. So think about that. You free rolled the trade. You're effectively break even. Can you get gap downs? Can you get slippages? Absolutely you can. Now we do this. So if you were to then get stopped down here, so that would be times by 1.97, which is your associated risk because you haven't moved your stop loss up. Look at that. $1,312.02. This is active risk mitigation. This is really important stuff that you don't get taught in any books. Just me on YouTube, basically. Don't see anyone else talk about this stuff, okay? Active risk mitigation, really important. So what you can do, okay, is what I try and do is I try and free roll the position into the first pop. So that period of contraction and then the expansion that follows, I'm trying to free roll into that, which is really important. I'm trying to sit through the testing action. Can I then add on a testing action? And then if the stock then reverses and trends higher, that's when I'm thinking about the optimization of profits. So that's selling rules, selling guidelines that I'm using to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain, also based on the stock's character. Does it like staying above the 10-day, the 21-day, the 50? Do I want to use a combination of moving averages? But that is active risk mitigation. Sorry, that is risk mitigation. Now, active risk mitigation is where you move up your initial stop loss. You ready for this? This is some Alice in Wonderland stuff here, ready? So what we could do here, watch this. As the trade starts moving out, so this is how my brain works. Now, my brain works very differently to many people's, okay? That's a function of ADHD and other things, right? But this is how my brain works. We work through the logical phases of a trade. I don't care if you're a day trader, a scalper, swing trader, position trader. There's 4 components to every trade. There's 4 components. Whether you're looking at the weekly chart or the 1-minute chart, it doesn't matter. There's 4 components. The first thing that you do, if you're any good, is you identify a setup as per your criteria. Then, which is then, they go like hand in hand, right, with a controlling risk. Well, okay, it's a nice setup, but how much risk do I have to take? Like if this here was a 25% stop loss because the ADR on this thing was like 50% and it's a 20, look, I'm not going to do it. The risk versus reward is all out of whack. Losses work geometrically against you. Okay, so when I'm looking at this here, I'm thinking about, okay, identify, I'm thinking about the control, the risk mitigation. But as I get filled on the position and my stop goes in, then my mind is just on risk mitigation. Remove the risk, remove the risk, remove the risk. So then in this instance here, what I could do as well, I could go, actually, do you know what? Look, $78 right there. You got the 50-day as well. Could I get my stop loss up to like 77.49? So that's just underneath a whole dollar, half dollar number. It's still underneath the 50. So what I could do here, if we go back like this and I go change this to 77.47, watch the purple and the green line. Do you see them come down? You see that? Now, why is that? Because what we've done is we've pushed our stop loss up. This is active risk mitigation. As I said, this is some Alice in Wonderland stuff right now. So what we do is we push the stop loss up. So as the trade starts to move in our favor, what I do is I'll push the stop loss up. I'm pretty aggressive with this stuff. That's also me and my personality. I'd rather get the risk out. I'd rather have half, 2/3 of my position there effectively risk-free and then see if this puppy can trend. I don't want to sit there rumming an R in and going, oh, maybe it'll go, maybe it, no, I'm just aggressive. The best ones go. Like the best ones, they just do that. They just go, no pressure. And again, any of you who have been trading for a little while, you probably read the Davis book, the Livermore book, you probably watched a lot of things on YouTube, taking courses, this, that, your own experience. Your experience may match mine and what you've read about, that your best trades, they put you under no pressure. They are basically profitable from the start. So if I know that my best trades are going to be profitable from the start, I just want to be in my best trades. The ones that and are and don't really go in, they're usually the ones that stop you out, right? So the way I'm then managing the positions quite aggressively early on is I'm just trying to get myself positioned more so in the ones that act the best early on are usually my best trades. So let me be aggressive with that third part of the trade, the active risk mitigation. Let me push it up. Let me be aggressive. As things starts moving, it shouldn't look back. Like the best trades, they don't look back in my experience. They just fly out the gate because a lot of other traders, a lot of other market operators see what you see, and then they are also willing to pay a higher price than what you paid. Okay, if I'm buying it here at 78.34, I need traders, other market participants, ready to buy at $79, ready and willing and do buy at $79, $80, $81, $82, $83. I need them to pay a higher price than I did. So this is where I need to have awareness of myself and the type of setups that I'm looking for, but also awareness of the type of stock that I'm looking for that setup on. Are other market operators, are other market participants going to be seeing this and willing to also be buying this? Are there reasons for the stock to go up? Okay, this is not a biotech stock that has a 100 million market cap, is about to announce phase 2 results, and then they need to go and raise 50 million just to keep the lights on. It's not that kind of stock. So you've got to know the type of stock you're trading. But here, with the active risk mitigation, if I'm pushing my stop loss up, as this starts getting out the gate, if I'm pushing my initial stop loss up from 76.37 to then 77.47, okay, so it's still underneath the 50 day, it's starting to go. Look at where my free roll targets are. Now it's at 79.21, and now it's at 80.08. You see this? So shall I just do that math for you again, so you can then see it on this instance here? We can do that, if you want to do that. Or actually, I'll tell you what, as a little homework assignment. Set this chart up, have a play with the fib retracement tool, and do a little bit of active risk mitigation for yourself. Okay, and just crunch the numbers, look at the math of it. Okay, and just understand, okay, if my initial stop loss is here, okay, where are my free roll targets? Do I then want to be moving it up? Because what you may also see, you may also go, wow, okay, there's local highs here. Okay, maybe I want to be trying to free roll underneath the local high, underneath the base high. So that active risk mitigation is going to be really, really important. So just do it. Just spend 15 minutes, half an hour, just going through some of your recent trades, ones which maybe popped, and then you're getting stopped out. Whack on the fib retracement tool again if you want to see the levels that I set it up. It's like this. Just go into the style. See these ones here. 0 is the stop loss. 1 is the entry. 2 is 1 times the risk as shown. But again, you can be changing the risk. 3 is 2 times the risk that is being shown. And then it's half at 1 times, and it's 1/3 at 2 times. So 3 up here. Okay, that is 1/3 of the position. So just have a play around with it. Crunch a couple of numbers and go, wow, actually, yeah, had I have moved up the stop loss a little bit and then sold part there into that local high, then actually I would have been out the other side with a break-even trade rather than a 3% loss, 4% loss, 5% loss, 2% loss, whatever it may be. I love active risk mitigation. So that's it, guys. I'll wrap the video up there. Hopefully that was useful for you in terms of last week learning about that pullback buy on Kinross Gold off the 50-day moving average with the shakeout demand tail. So I like shakeout demand tails. Maybe next week I'll do one on gap down reverse bars, but this one here was the trigger bar. But I really wanted to go in depth in terms of the trade management, teach you about risk mitigation, active risk mitigation, because I think it's a really, really, really important part of trading, which I don't think is commonly discussed. So thank you very much for watching. Certainly if you made it all the way to the end of this video. If you're new here, you like these kind of videos, and please do consider subscribing for more like this. And as always, I look forward to seeing you guys in a future video.